Hi, I'm Rick Kaler. Over 25 years of writing this column, I've often discussed the value of a static buy and hold asset allocation with periodic rebalancing. What's that? Well, this means investing specific percentages of your portfolio in several asset classes, a few of which are stocks, bonds, commodities, and real estate. Then, at least once a year, you buy or sell gains or losses to readjust each asset class back to the original target allocation. Doing this can keep you from making what a lot of my peers call the big mistake of investing. Maybe I should say the big, lethal, fatal mistake of investing. An April 8, 2015 article in Advisor Perspective by Lance Roberts of Street Talk Live shed some new light on the real value of maintaining a static buy and hold strategy. Roberts cites from the 21st Annual Quantitative Analysis of Investor Behavior done by Dalbar Incorporated. It shows that in 2014, investing in a static buy and hold strategy, which was allocated 60% to stocks and 40% to bonds, would have earned an additional $6,830 a year on every $100,000 invested. That's 6.8%, compared to the average amounts such portfolios actually earned. That's huge. The Dalbar study found the average return for both do-it-yourself investors and investment advisors on a 60-40 portfolio from 1984 to 2014 was a dismal 2.56% a year. The average annual return of the buy and hold strategy was 9.68, meaning the average investor and investment advisor left 7.12% of return on the table every year. Now, put into dollars, investors and investment advisors earned about $25,000 on every million invested in the stock market. Had they simply put that million into buy and hold strategy allocated to 60% stocks and 40% bonds and left it alone, they would have earned $96,000 a year. That's a loss of $71,000 annually. That's $71,000 annually that could have been in their pocket that they left on the table, so to speak. Now, why do so many investors and investment advisors do so poorly? The biggest reason listed by Roberts, which is supported by my own observation, is psychology. Investors exhibit behavioral biases that lead to poor investment decision making. Dalbar listed 9 irrational investment behavior biases that reduce returns and found that 2 of them were the most significant. Those were the herding effect and loss aversion. It's just human nature, both to want to follow what everyone else does and to be afraid of losing what we have. Put those together, these can lead to investing disaster. Roberts explains that as markets rise, investors come to believe that things are better and the current upward trend will continue indefinitely. The longer the trend lasts, the more ingrained that belief becomes that things are better, things are great. Eventually, the market enters a euphoric time of price increases when the last of the unbelieving holdouts, who are now believing things are better, finally buy in. When the market inevitably declines, investors view the dips as buying opportunities. Then as the markets continue to drift lower, there's a slow realization that the decline is something more than a buy-the-dip opportunity. As losses mount, fear of losses increase until investors can't stand the heightened feelings of anxiety and sell out to avert further loss by selling. This whole process results in most investors buying high and selling low. which runs counter to the buy low, sell high investment rule. Put in more basic terms, the reason most investors and advisors do so poorly is they try to time or beat the market. The study found that while most investors and advisors guess right 67% of the time, they were not able to come close to equaling a buy and hold strategy. In fact, they only earned 2.56% guessing right 67% of the time. So what can you do to keep from sabotaging your own investment strategy? It becomes imperative to put a system in place which will make it difficult for your brain to panic in a downturn. And we will explore that next week in my column or next week in this video. And we'll take a look at some of the options that you have. Thanks for listening.